Hi, welcome to DayTradeToWin. Today I just wanted to say a few words about support and resistance. I might have mentioned this in an earlier episode in the series as well. If that's the case, then just let me repeat myself because I think it's important and it will help you a lot in how you look at the market and how you read price action. We're going to take a look at the E-mini S&P 500 here, an intraday 5-minute chart. This is actually the overnight session, the London trading session of the E-mini S&P 500. Now, when you find a stock or a futures contract or a forex pair reaching a level of support or resistance like you have in the chart here, or if it's being caught between support and resistance in a trading range, you can use the price spread and the volume to gain important insights in what's happening behind the scenes, and you can then use that to your advantage in your trading. So these levels of support and resistance are formed because at the level of resistance, there are going to be a lot of trading. There's going to be a battle for dominance between the buyers and the sellers, the bulls and the bears. If the sellers win, the price is going to go back down. If the buyers win, the price is going to break through this level and a new uptrend would be formed. This is all based on supply and demand that we covered in the beginning of this video series. So there are going to be a lot of orders to go short around this price level here. Traders will have orders sitting here. Some will be here, a little bit lower. Most are going to be right here in the middle, and some are going to be a little bit higher. As their trigger prices get hit, these orders are going to be sent automatically. Then buyers will need to step in and buy in order to break through the resistance. They'll need to buy. The more buyers, the bigger the battle is going to be. Short sellers are going to join, and so on. So you will see all of this effort in the volume. As the price approaches the level of resistance, the volume is going to increase because there are more and more orders coming in, more and more buying, more and more selling. If the sellers win, this is going to happen. The volume increases as the price approaches the level of resistance. Price will reverse and start moving downwards, and the volume is going to diminish because fewer buyers are now participating in the trading. They see that it's not worth trying to force the price up for the time being. And this can continue a few times. The market approaches the level of resistance, it reverses and pulls back. Let's take a look at a 1-minute intraday chart of the E-mini S&P 500. Here we have a textbook example of resistance right here at 29.7950. Now we can all see that the resistance line here can be drawn like a straight line here. The market stays below this resistance line for a long time. It tries to break through, but the sellers keep pushing the price down. But then, when the time is right, the market again tests the level of resistance, and this time more and more buyers are going to participate, and you will see this in the volume. You will also see it in the price spread, the size of the candles. Usually a breakout happens on huge volume and with a big spread like this. So this is a textbook example. In real trading, on the other hand, things are not always going to be as clear-cut. If we go back to the 5-minute E-mini S&P 500 futures chart, you see that we have this area of consolidation. This is somewhat of a range. The market tries to move upwards here, but you see the volume here coming in, pushing the market down, resulting in this huge wick. Same thing here, there's a big push upwards, but sellers come in and push the market down on this big volume. And here's another push upwards, a huge candle on huge volume, and the market gets pushed down and we get this long wick right here. See, sometimes when the price is approaching the level of resistance, it won't reverse at the same price. It reversed here, the next time it reversed here, third time it reversed here. This is still the same general level. What is this? This is a difference of 1 point from the high here to the level it closed under right here. In this case, I would consider this level as a real area of resistance. The price tried to go up, but wasn't able to close there. It was forced back down below the resistance. Then what do we have here? A breakout, right? The market breaks out above this resistance that we have identified. So far so good, but look at the volume. It's peanuts. The volume is super low. It's not what we would expect on a breakout. So this is a false breakout, a bull trap if you will. So now we know that the market is not able to move up, so the line of least resistance is down. So what can we learn from this? Well, first of all, what I do, I never consider highs and lows in a range or at support or resistance to be exact prices where a reversal is going to happen. I consider it an area of support or an area of resistance, an approximate or general price level where we know there are going to be a lot of selling coming in as buyers want the price to go higher. This selling is not going to happen at the same rate, at the same price level all the time as the market stays stagnant. So when you're looking for the breakout in a trading range, don't just consider two straight lines, one at the top, one at the bottom. The support and resistance will change over time as well. In this case, the actual breakout from this stagnation actually happens right here. It's a breakout lower, but if we just use high and low points and stick to those, we're going to miss a lot of price action. In this case, we would miss this breakout. The level of support and resistance is not always going to be a straight line in your chart. It can be, but quite often you can draw it freehand like this. Here at the low of the consolidation, if we just draw a straight line from the lowest point, we're going to miss this move. In this case, you could have drawn the support line like this, more like an arch. My point is that if you would have the chart printed on a piece of paper, then you would draw the resistance lines with a wide marker on freehand. You don't take your ruler and draw straight lines with a sharp pencil. You need to be a lot more dynamic than that when you analyze price action. Instead of looking for straight lines, you should analyze the price action and the volume to see where the real effort to break through resistance or support is happening. Then the next step is to trade the breakout. We have videos in this video series explaining the best ways to trade breakouts through support and resistance. And you can also use software like the Trade Scalper to find the best trades, like the 1 minute chart we have here. The Trade Scalper gave us a long trading signal right here, and here we had some short signals on the way down. There's a lot to learn in price action, and it will help you tremendously in your trading. So make sure you subscribe by clicking here and watch this whole playlist to learn price action trading. That's it for today. Until next time, good trading.